We've got about 15 minutes to go before the closing bell, so let's speak with Diana Avigdor. She's head of trading at Barometer Capital Management, joining us now from the TSX. Diana, a lot to talk about, and a lot of people trying to figure out which way this market goes. Do you want to sell into strength, or do you buy in the dips? What's your assessment here?
We have some. We take the guessing work out of this because it's so volatile, and it does round trip 3 times a day. And January up till year to date has been extremely volatile and sloppy. We have specific systems and processes that we look at, and we look at a lot of different breadth models, sectorally, internals, top down. Our breadth models have gotten very oversold and are now starting to look a little better. So we went into the year end and early week fully hedged, which was a good thing, and then we ended up taking those hedges off about a week ago, a few days ago, depending on the portfolios. And some of our portfolios are fairly balanced. Some still hold about 10% cash to take advantage of this kind of volatility. We're not fully out of the woods, but given the outperformance that we've had year to date, we felt that the market was oversold enough that we were able to take the risk and stay long. And remember, hedging just takes your exposure down, doesn't take you out of your favorite stocks. So when you take those hedges off, you're left with a ready set portfolio, and hopefully of those stocks that you like, because what we always say is sell the ones that are not working, don't sell the ones that are. So you end up with a portfolio of stocks that are working, not with a portfolio of stocks that is just not performing.
But you could have said that with the Googles of the world, right? And a lot of those stocks are down. So I don't know that hasn't worked for a lot of people, Diana.
But you know what? You have to have the discipline, and you have to have your exit point, and you have to have your stop losses. And those stop losses have to be executed on without emotion. And I can give you examples of stop losses that have gotten us out of names, and thank God they did. And then sometimes if you're wrong and you got a paper cut, and that was wrong because it's so volatile, it's okay to buy it back higher than where you sold it, because the idea is not to buy the bottom and sell the top. We can't do that, but it's to gradually and granularly make money. So we always, on all of our stocks, we have our exit strategy. We have our stop losses. They are dynamic. They do depend on many different things, be it technicals, be it fundamentals, be it relative strength to other things. VRX, for example, we have a very good example how it turned down, and we didn't catch the top, but we certainly did not ride it down. So you have to have your stop losses on absolutely every single position.
Diana, it's interesting that you're talking about stop losses. I think there's probably a lot of people who have been wishing that they had some of those stop losses on stocks, and I hear you when you say it's dynamic and probably changing depending on the fundamentals, and that's what you're going to look at every day. But as a range, what kind of down ticks are you looking for? Where do you put the stop losses? Is it down 5%, 7, 10? I know it's going to change, but what's an average here that other people, viewers at home, can think about?
So I would recommend that you look at every single individual position in its singularity. So it depends on why you bought it. So say, for example, a stock is breaking out to a new 52-week high and is extremely away from its moving averages. Let's say it's extremely extended, but you're buying a high PE stock, not because it's expensive, but because you're expecting it to grow, and all kinds of stories that you have around it. Your stop loss will be different. It will be depending on where you bought it. It'll depend on why you bought it, and it'll depend on the temperament of the stock. A stock like Amazon, for example, moves $30 a day. You can't have a $15 stop loss. It'll take you out and in every single day. So you have to have your levels. Now you have a portfolio, and this is why you give your money to a portfolio manager. You have a portfolio of 40, 50 stocks. In the stock market of 10,000 stocks you're watching, at any given time you want those 40, 50. It's going to depend on how the rest of the market's doing. So say, for example, you had Amazon at the new highs, and all of a sudden it's not performing.
Right.
Everything else is. So now you may not be losing as much. Maybe it's still moving up 1% a day, but everything else is going up 5%. So you're relatively not making money where you should be. And on the downside, the same way. What you're holding goes down more than something else. You have to take in consideration the volatility parameters of the stock. It can't be, you can't say that, oh, it's a 5% and that's it, because you know, sometimes that's the daily move of the stock.
Right. All right, Diana, good to be with you. Thanks so much for joining us.
Thank you very much.
Thank you.